Most people know about 2008, the financial crisis, the housing collapse, Lehman Brothers, the Great Recession. It's taught in economics classes. It's referenced in every risk conversation. It's the modern benchmark for financial catastrophe. But there's another crash, less dramatic in the news coverage, less cinematic in the storytelling, less discussed in personal finance conversations, and arguably more destructive to ordinary American savers than 2008 ever was. The crash of 2000 to 2002. The dot-com collapse. The event that quietly wiped out retirement accounts, destroyed decades of accumulated savings, and permanently altered the financial trajectory of an entire generation of Americans who did everything right, who saved consistently, who invested in their 401ks, who trusted the system they were told to trust, and watched it take away 40 to 50% of everything they built. In some cases more. Today, we talk about what actually happened, why it happened, why it matters to you right now in 2026, and what the lessons from that forgotten crash should be changing about how you think about your financial future. The 90s and the greatest bull market in history. To understand the crash, you have to understand what preceded it. The 1990s produced the longest sustained bull market in American history up to that point. From 1990 to 2000, the S&P 500 produced returns of approximately 417%, nearly 4.5 times the starting value in a single decade. This was not normal. This was extraordinary, historically anomalous, returns that dwarfed every previous decade in modern market history. But it didn't feel extraordinary to the people living through it. It felt like the new normal. It felt like the economy had entered a permanently elevated state of growth, powered by technology, globalization, and the internet revolution. Financial media reinforce this narrative continuously. New economy, new paradigm, old valuation rules no longer applied. Companies without profits, without revenue, without business models were valued at billions because the internet changed everything. Price-to-earnings ratios on major indices reached levels that had historically predicted severe corrections. In 2000, the NASDAQ traded at price-to-earnings ratios above 100. The long-term historical average is roughly 16. The market was not just elevated. It was pricing in decades of future growth that had not yet occurred, and in many cases would never occur. Ordinary Americans, watching their 401k balances double and triple through the 90s, made reasonable conclusions. The market works, investing works, the future is bright. They were right about the first two. They were dangerously wrong about the third. What actually happened?
March 2000. The NASDAQ peaked. Then it began falling, not in a single dramatic day. Gradually at first, then faster. Then catastrophically. The NASDAQ composite fell approximately 78% from its March 2000 peak to its October 2002 trough. 70%.
A $100,000 NASDAQ heavy portfolio in March 2000 was worth approximately $22,000 in October 2002. The S&P 500 fared better, but still fell approximately 49% peak to trough over the same period. Companies that had been valued at billions became worthless within months. Pets.com, Webvin, Kosmo.com. Hundreds of companies that had raised enormous capital from retail investors went to zero. But the destruction extended far beyond failed startups. Established technology companies that had genuine businesses, Cisco, Intel, Oracle, Qualcomm fell 70–90% from their peaks. Not because their businesses failed, because their valuations had been detached from business reality. The correction was not a market failure. It was a return to historical valuation norms from levels that had no precedent. Who actually got hurt? What the historical narrative often misses is who actually suffered most. The 2000 to 2002 crash didn't primarily hurt professional investors. It devastated ordinary Americans whose retirement savings had been shifted from traditional pensions into 401k plans and IRAs during the 1990s. By 2000, millions of workers had retirement portfolios heavily invested in stocks, especially technology. When the market fell 40 to 50%, people nearing retirement didn't have decades to recover. Many delayed retirement by years. Some never retired at all. Those who had already retired faced the harsh reality of withdrawing from portfolios that had been cut nearly in half, turning once safe withdrawal rates into unsustainable ones. For an entire generation of Americans, sequence of returns risk stopped being a theory and became a life-changing reality. The psychological destruction. The financial loss was severe. The psychological damage was even deeper. A generation of Americans who had trusted the market and faithfully invested for retirement watched much of what they'd built disappear. They believed they had done everything right, only to see years of savings evaporate. The emotional response was predictable. Many sold at or near the bottom not because they were irrational, but because the pain of losing so much overwhelmed the knowledge that selling would lock in those losses. Others went to the opposite extreme. They abandoned stocks entirely, moving their money into cash or bonds, and never returned equities in meaningful amounts. They avoided another crash, but also missed much of the market's long-term recovery. Both responses reduced lifetime wealth in ways that are difficult to fully measure, but undeniably significant. And perhaps the greatest loss wasn't financial. The confidence of the 1990s, the belief that investing reliably built wealth, that the system worked, and that the future was bright, was replaced by skepticism that lasted for years. For some Americans, it never disappeared. What the 1999 retiree actually experienced. Let's put specific numbers on what this meant for real people. Someone who retired January 1, 2000 with $500,000 in a diversified equity portfolio. They planned to withdraw 4% annually, $20,000. This seemed conservative. The 90s had produced returns far above 4%. Their financial advisor had validated the plan. By October 2002, their portfolio had declined approximately 45% to $275,000. They'd been withdrawing $20,000 annually. Over those 34 months, they'd withdrawn approximately $56,000. Portfolio value after withdrawals and market decline, approximately $219,000. They'd started with $500,000. They now had $219,000. Their original 4% withdrawal rate was now a 9% withdrawal rate on the remaining portfolio. A rate the research clearly shows is not sustainable over a long retirement. They had three realistic options: drastically reduce spending, return to work, or run out of money within 10 to 15 years. None of these were the retirement they'd planned. None of these were the outcome the system had promised. What was different about 2000 versus 2008? Here's why 2008 gets more cultural attention despite arguably causing similar financial damage. 2008 had a clear villain: banks, mortgage companies, Wall Street greed. The narrative was compelling. The documentary was made. The movie won awards. 2000 to 2002 had no clear villain. The market just returned to historical norms after a speculative bubble. Companies that were never worth billions turned out to not be worth billions. Prices corrected. It's harder to make a movie about a valuation correction. It's harder to find someone to blame when the market simply returns to historical averages after a decade of extraordinary returns. But the damage was just as real, and in some ways more insidious, because the preceding decade had been so extraordinary that the correction looked even more catastrophic by comparison. The lessons that most people didn't learn. 26 years after the peak, the crash of 2000 left 4 lessons every American investor should remember. Lesson 1: Valuation matters. In 1999, warning that technology stocks were trading at extreme valuations was unpopular. Critics said the old rules no longer applied. They were wrong. When prices move far above historical norms, the risk of a major correction rises no matter how convincing the story sounds. Lesson 2: Sequence of returns. Risk is real. For people within 5 to 10 years of retirement, a major market decline can permanently change retirement plans. It's not an academic concept, it happened to an entire generation, and it will happen again. Lesson 3. Diversification isn't always real diversification. Many investors believe they were diversified because they owned multiple technology stocks or tech funds. When the sector collapsed, nearly everything fell together. True diversification means spreading risk across sectors, asset classes, and geographies, not just owning different versions of the same investment. Lesson 4. The last decade doesn't predict the next. The extraordinary gains of the 1990s convinced many investors that similar returns would continue indefinitely. Instead, the following decade delivered the opposite. Assuming recent performance will repeat is one of the most costly mistakes in investing. Why? This matters in 2026. The reason to understand the forgotten crash of 2000 is not nostalgia, it's pattern recognition. In 2026, valuations in certain market segments are again elevated relative to historical norms. Not necessarily at 2000 levels, but elevated. Artificial intelligence excitement has produced valuations in technology companies that price in enormous future growth. Concentration in a small number of large technology companies represents a significant portion of major index funds. The 10 largest companies in the S&P 500 represent a historically high percentage of total index weight. This doesn't mean a crash is imminent. Markets can remain elevated for extended periods. Elevated valuations are not a timing mechanism. It means risk is higher than it would be at historical average valuations. It means the potential for a significant correction exists. It means people near retirement should be thinking carefully about sequence of returns risk right now, not after a correction begins. The generation that got hurt worst in 2000 was the generation that arrived at retirement at the exact wrong moment. They couldn't control the timing of their retirement relative to market cycles, but they might have controlled their portfolio's vulnerability to those cycles if they'd taken sequence of returns risk seriously before the crash rather than after. An entire generation of Americans did everything they were told to do. They saved consistently, contributed faithfully to their 401ks, and trusted the system to provide for their retirement. Then, between 2000 and 2002, the market erased 40 to 50% of their savings at the worst possible time, just as many were preparing to retire. The crash is often overlooked because it lacks a clear villain, but its impact was real, affecting millions of ordinary people who had spent decades building their financial future. The lesson isn't to fear the stock market. Markets have always recovered, and investors who stayed invested eventually regained their losses. The real lesson is that your stage of life matters. Young investors have time to recover from major downturns. Investors near or in retirement do not. For them, sequence of returns risk is one of the greatest financial threats, and it must be managed before the next crash, not after. The generation that suffered through the crash of 2000 didn't know it was coming. Another market crash will come someday. The timing is uncertain. The certainty is not. Manage your portfolio accordingly.